Hi students, let's look at the questions I gave you on budgeting. That's fun. The company issued its production budget based on anticipated output of 800 units. Actual output was 1000 units. The details of the costs are shown below. Output budget 800, actual 1000. Prime cost, fixed overheads, and total cost are given. Total budget variance. You remember when we prepared flex budgets, I showed you uh, budget volume variance and budget expenditure variance. Let me show you quickly again. Can you see here? You prepare the fixed budget and then flex budget. The difference between fixed and flex budgets is what we call budget volume variance. Similarly, the difference between flex budget and actual is what we call budget expenditure variance. If you add these two, that is what you call total budget variance. So basically, total budget variance, let me show you. Is the difference between total and the fixed budget and actual. Right. What I am showing by the red color arrow is what you call total budget variance. Total budget variance. So 73,000 is the fixed budget. Actually 74,900. $1,900 additional cost. It has to be 1,900 adverse. If you know the volume variance and the expenditure variance, you can add them together. 3525 adverse, 1625 favorable, add them together, that will be 1900 adverse. So coming back to the question, now we have fixed budget is 99,000 cost, actually is 114,000. So the difference is $5,000 adverse, $5,000 adverse. That will be the total budget variance, which is option D. Option D. Question number 1, option D. 2. Each unit of product smitten uses 5 kg of material B. The budgeted details for March are as follows. Product smitten, opening inventory, closing inventory, material that 1000 kg, 1500 kg. It is anticipated that sales of product smitten in March will be 20,000 units. Amount of material that needs to be purchased. So you have to first prepare the production budget. From production budget, then you have to move on to material budget. Sales 20,000 units. Sales 20,000 units. Opening stock, closing stock. Closing stock of finished goods. Smitten is the finished good. 11,000 is the closing stock. Opening stock 9,000. So production has to be 22,000 units. This is the production budget. Production 22,000. Then to prepare the usage, production 22,000, and then usage 5 kg each. Total usage will be 22,000 into 5. Then opening inventory, closing inventory. Closing inventory is 1,500. Opening inventory is 1,000. Minus 1,000. Opening inventory 1,000. $110,500 is the purchase quantity. Next one. Master budget is the consolidation of all subsidiary budgets. It's a consolidation of all the subsidiary budgets, which is option B. Third one, option D. Flexible budget. Flexible budget means budget like fixed budget means what? budget for particular number of units only. Flexible budget means it will have multiple columns. For example, think next month you are planning to sell 100,000 units, but there is uncertainty whether you can sell 100,000 or not. So you prepare a budget. One column shows 90,000 units. Another column shows the outcomes of 100,000 units. Another column shows the outcomes of 110,000 units. Likewise, you identify all the possible outcomes and prepare the budget for each of those outcomes, each of those number of units. So basically, you have one budget which identifies possible number of units and shows all the cost and revenues for all those number of units is what you call a flexible budget. See, I'll show you an example. A flexible budget example. Volume 1000, 1200, 1500. Sales, direct material, direct labor, variable overhead, fixed overhead, profit. So if you prepare a budget in this format, this is a flexible budget because it shows 1000 units, 1200 units, 1500 units. All the different activity levels are shown here, which is what you call flexible budgets. Here, a budget that can be flexed if the activity level is different from the forecast, right? Activity level, we are showing different activity levels, right? That's what you call flexible budgets. Option C. Option C. The company issued its production budget based on anticipated output of 2000 units. Budget volume variance. Budget volume variance, you have to prepare the flex budget. Fixed budget is given to you 2000. Let me copy that. Fixed budget 2000 units. Flex budget must be for 1500 units. Why? The actual is 1500. Prime cost 50,000. If it is 50,000 here, it must be 50,000 divided by 2000 into 1500. That is 7500 because prime cost is variable. Prime cost is variable. Fixed overhead 130,000. Fixed overhead should not change. Total cost is this fixed budget. Flex budget. So the volume variance is 12,500 favorable. 12,500 favorable. Why? The cost, this is total cost, right? Cost has reduced. Cost has reduced. 12,500 pounds favorable. So see, this is what I told you. When they ask you in the exam, the pound sign will be given. Just the number only you have to type here. Don't even type comma or space or anything. Just 12,500. Question repeated, I think. Question repeated. 5 and 6 are same. 7. Place the following budgets in the order that they would be prepared. Assume that sales volume is the principal budget factor. So you have to start with sales budget, then production budget, material usage, material purchases. CABD, option A. Option A. That's straightforward theory question. A manufacturing company makes product called Delta. Each unit of product Delta uses 4 kilograms of raw materials. Data for next month's budget for product Delta is as follows. Opening inventory. Right. How many units of Delta should be produced in that month? Sales, how much? 75,000. Then sales is that. Opening inventory, closing inventory. Delta 1500. and 10,000, 10,000. $75,500, 500, that's all. So there is a lot of redundant data. They are talking about material wastage and all that. To find the production, you don't need all of this. So 75,500, 500 is enough. Option B. A company has produced its cash budget for the year in that year and is concerned at the level of cash deficit being shown. Which three of the following would enable the company to reduce its cash deficit in short term? Take longer to pay suppliers. See, you're talking about short term deficit, right? Yes, discussing or negotiating with suppliers and delaying the payments is one option. Option A, right? Purchase new non-current asset. No, already you don't have money at this time. Going and buying non-current assets doesn't make sense. B, wrong. Increase the overdraft facility. Yes, because it's a short-term problem. You can go for a short-term solution like overdraft. Correct. C is right. Lease rather than purchase new non-current assets. Increase receivable levels to encourage sales. No, because when you give more receivables is when you are cash rich. You don't have cash problem for a few months, then at that time you can increase the receivables. Here you already have cash problems. At this time, if you give extended credit periods, you are in trouble. Reduce inventory level of finished goods. Yes, that is also an option because you can convert the finished goods inventory into cash. So you can reduce the amount of cash that is blocked in the inventory only for those few months. So which are right here? Take longer to pay suppliers. A is right, C is right, F is right. ACF. ACF. In this question, I did not take this one, take lease rather than purchase option because the cost will be different. Now, leasing, then the interest cost and all that will come into play. So, like purchase cost changing, then thereafter whether purchasing whether it is viable or not, again we'll have to evaluate and all that. So that's why I kept it aside and I checked whether I have any other three answers. Yes, take longer to pay suppliers, increase overdraft facility, reduce the inventory. Yeah, those three look better options. Yeah, but fourth one would have been that lease rather than purchase new non-current assets. Where the other problem, that is a long-term nature issue. Like see, non-current assets. If you are buying, let's say you want to buy a building, better option, don't buy it in those 3 months, 2 months. Suppose it's a short-term deficit, right? Maybe 2 or 3 months you have this deficit. So in that period, whatever you wanted to buy, just delay it and buy it later. Because lease rather than buy means that's a long-term nature issue because you go and lease an asset that runs for like 5-6 years, isn't it? At least 2-3 years. So that's not really a short-term solution. That's a long-term activity you are doing. Therefore, for a short-term solution, that's not a very good idea to go with lease rather than buying. Next, a lot of information. What does it say? Which three of the following statements can definitely be inferred from this control statement? Ooh, let's see. Total expenditure variance is adverse. Total expenditure variance is adverse. Material price variance is favorable. Which we can't say because now first one I'll come back to that later. Material variance, the total is 1500. This can be because of price or usage, I don't know, which we can't say that. So obviously second one is wrong. Selling price variance is favorable. Let's check that. Flex budget sales for 6500, budget is 390. For the same 6,500 units, your actual sales is 394,500, right? Okay, yeah. So this is wrong. Okay. Here, 6,500, 390,000 is the revenue. For the same 6,500 units, 394,500. So obviously you have sold at a higher price. Otherwise, for the same volume, actual revenue is higher means you have sold at a higher price. That is right. That one is right. Variable overhead efficiency variance is adverse. Variable overhead total variance is adverse. I don't know whether it is because of efficiency or not, which we can't say that. That is wrong. Sales volume contribution variance is adverse. Yes, because original budget is 7,300, what you have sold is 6,500. You have sold less volume, right? If you sell less volume, volume contribution variance will be adverse, correct? Labor rate variance is adverse. No, we can't tell about labor. That is wrong because labor total variance is adverse. Total adverse means it's including efficiency and rate. So I don't know whether rate is adverse or not. It could have been favorable. So that is wrong. Now coming to the first one. Total expenditure variance is adverse. Total expenditure variance means look at the total cost flex budget 309,000. Total cost actual 313,000. This difference is what we call expenditure variance, right? Budget expenditure variance. Remember, similarly, this difference, total budgeted cost and flex budgeted cost is what you call volume variance, budget volume variance. Now, budget expenditure variance means flex budget shows 309,000, but you have spent 313,000. 4,000 additional expenditure you have, therefore total expenditure variance is favorable. Adverse is right. Cost increasing is adverse, isn't it? 4,000 adverse, that is right. So the statements that are right here, ACE. Right, ACE. Seventh one. Sales. Where is the sales? 70,000 units. Opening stock 5,000. Closing stock they want to increase by 30%. 70,000. Closing stock will be 5,000 plus 30% of 5,000. They want to increase it by 30%. So that is 6,500. Opening stock 5,000. So production will be 71,500. That is 11th one. 12th one. What will be the purchases budget for material X? So purchases budget. Purchase per unit is 5 kilograms. Opening 50, closing 60. 5 kilograms. 71,500. 5 kilogram per unit. Total usage is this. Closing stock, opening stock. 367,500. 367,500. See, when you're doing for the exam, don't waste your time, writing all these descriptions, all that. Just put the numbers only and get the answer faster. Time matters. 13. Principal budget factor. The budget, a factor which limits the activities of the organization and is often the starting point of budget preparation. Yes. A. 14. X Limited is preparing its budget for the forthcoming year. The estimated sales for the first 4 months of the forthcoming year are as follows. 40% of each month's sales units are to be produced in the month of sale, and the balance is to be produced in the previous month. See, it's like if I'm going to sell 100 units this month, last month itself I would have produced 60 and kept it to be on the safe side. Only 40 I'm going to manufacture for this month's sales. Basically, every month sales, 60% of that month's sales should remain as closing stock from previous month. Let's say here month 1 or month 2, 7,000 units you want to sell, right? 60% of this, that means 4,200 must be the closing stock of month 1. When you finish month 1, already you have produced 4,200 and kept it in the stock. That's what they say. 50% of the material required for each month's production will be purchased in the previous month. Material cost is 5. Production budget in units for month 1. Look at these. Month 0, 1, 2, 3. Sales. I don't know, month 0 sales, which is not given. 6,000, 7,000, 5,500. 6,000. Plus closing stock minus opening stock. So closing stock has to be, look at this carefully, 60% of next month's sales. 60%, 6,000 into 60%. Agree? Similarly for next one, how we to get that 7,000 into 60%. For each month you can find the closing stock. Opening stock, previous month's closing stock is the opening stock. But I have to put a minus sign there. Correct? So production. Which month production did they ask us? Production in month 1. 6,600 is the answer. Material cost budget for month 2 will be. So let's copy the production. Oh wait. Right, that's the production. So material usage, they said 5 pounds each. They have given in pounds, that's okay. Let's copy in pounds itself. Total usage. This is usage per unit. Total usage. Then what you do, they say 50% of material required for each month will be purchased in the previous month and 50% in the following month. So opening stock, next month usage into 50% must have purchased in the previous month. That means when month 0 finishes, you will have 16,500 in stock. Similarly, each month you can find it. How did you get 50 into 50? Month 2 requirement is 30,500. Of that, 50% you purchase in the previous month itself and you keep it. Similarly, this 14,500. How about closing stock? First month's opening stock is the second month's closing stock. Simple as that. Other way around. Oh wait. This is closing stock, not opening stock. This is closing stock. This is opening stock. Now okay. First month closing stock is the opening stock for next month. Simple. Right. So the purchase usage plus closing stock minus opening stock. Minus opening stock, already I put the minus sign there. Which month did they ask? They asked for month 2. 29,750 is the right answer. 29,750 is the right answer. Check all this. When calculating the material purchases budget, quantity to be purchased, usage plus closing stock minus opening stock. First answer itself is right. Usage plus closing minus opening. First answer is right. 17. The following details have been extracted from creditors' records of exhibited. For suppliers paid in the month of purchase, a settlement discount of 5% is received. Okay. How much will be paid in September? July, August, September, 250, 300, 280. Let's write those details. July, August, September, 250, 280, 300, 280. Then they say 25% invoices paid in the month of purchase, 70% in the month after, 5% in the second month. September collection will be this into 25%, but there is a discount for the same month period, right? For suppliers paid in the month of purchase, a settlement discount of 5% is received. So again, you multiply by 95% to subtract that 5% settlement discount. Then this into previous month sale into 70% plus the month before that into 5%. 289,000 is the right answer. 289,000 is the right answer. 280,000 same month sales into 25. Previous month sales into 70. The month before that into 5. For the same month, again you do a net of discount adjustment. So the figure you got there, I multiplied by 95%. You can see here. Yes. 18. Budgeted sales of X for December are 18,000 units. At the end of the production process, 10% of production units are scrapped as defective. Opening stock for December are 15,000. Closing stock will be 11,400. Okay. We have done questions like this: sales 18,000, closing stock 11,400, opening stock 15,000. So you get the production is 14,000. But this is good production, good units production. And you remember we did calculation like this: if 10% is defective, this must be 90%. This is 90%. The total production has to be 14,400 is 90%. How much is 100%? 16,000 would be the answer. 16,000 would be the answer. I have done questions like this. That means production budget with defective production. They are talking about flex budget profit. Flex budget profit. Flex budget means we are prepared for 12,000 units, right? So 45, 10,000 units. Let me copy that. 10,000 units. Let me write the revenue on the top line. 150,000 is the revenue. Then material 45, 30, 20. 45, 30, 20. Fixed overhead 25,000. This is the budget for 10,000 units. I have to prepare the budget for 12,000 units now. It will be 150,000 sales revenue divided by 10,000 into 12,000. Do the same working for all other than fixed overhead. Fixed overhead, you will just copy 25,000 itself. Correct? So to find the profit, what you do? Revenue minus all the costs, sum of all these costs. 41,000 is the right answer. 41,000, option D. 20th one. Each unit of product alpha requires 3 kg of raw material. Next month's production budget for product alpha is as follows. Number of kilograms of raw materials that should be purchased. 60,000 is the sales. So first we have to prepare the production budget. Production budget. 60,000 sales. Closing stock. 3,000 units. 3,000. Opening stock 2,000 units. So production will be 61,000. Then 61,000 into usage per unit 3 kg. You multiply and get the total usage. Stock of raw material, closing 7,000, opening 15,000. It's 175,000. 175,000, option B. First one. Which of the following would not be included in the cash budget? Depreciation, yeah, it's not included. Provision for doubtful debts, no. You don't keep provision for doubtful debts, no. Because that's all accounting. For us, what matters in cash budget is whether cash comes or not, right? Wages and salaries, that is included. So which of the following would not be included in the cash budget? Depreciation, provision for doubtful debts, A and B. A and B. What we do, the bad debt allocation, what we do, we don't show that as a separate cost item, right? Remember, suppose if we have 5% bad debts, if you are expecting 5% bad debts, okay, we actually allocate that provision, but how we do that is, when we show the income itself, we would have excluded that 5% and we show it. Whereas in financial accounts, what you do, you show the total revenue in the top line. Later you show as an expense, provision for bad debts. Here we don't do all that. We simply deduct that amount also, and the rest only we are going to show as inflow. So if they ask you provision for bad debts, is it shown in the cash budget? No, it is not shown in the cash budget. We don't show it as a separate item. 22. It's about collection. June, July, August, September. June, July, August, September. Sales 35, 40, 60, 45. 35, 40, 60, 45. September is the question. Month after sale 60%, then there is a discount of 2%. Month after sale means is 60,000 into 60%. There is a discount of 2%. Adjust for that. Then 25% from 2 months. That means from this plus 12% 3 months. 12%. 49,480 is right answer. 49,480 is right answer. Each finished unit of product H contains 3 liters of liquid L. 10% of the input liquid L is lost through the evaporation in the production process. Budgeted output for product H is 3000 units. So see, I have done one question like this in the standard costing also. Output contains 3 liters. Let me show you that question version. Standard costing. Look at this one. See, if you give input of 100%, 10% is wasted. Output is 90% only. And output bottles each have 3 liters is what they say. Each output bottle has 3 liters. Yes. And they want to make 3000 units. So look at this. Okay. So input for 3000 units will be, look at this carefully. For 1 unit, how much it will be? 3 liter comes with the output, right? Which is 90% is 3 liters. So how much should be 100%? 3 divided by 19 to 100. This would have been the input for 1 unit. This would have been the input for 1 unit. Right? Like that, you are going to make 3000 units. So the total input has to be 10,000 liter will be given as input. Double check if we give 10,000 liter, 10% of that 1000 liter will be out. 9,000 liter comes here. Each bottle takes 3 liters. So 9,000 liter coming here, 3 liters, that's 3,000 bottles. Perfect. But what is the question now? Required purchase. So this is like the usage, right? Input means that's the usage. So usage is 10,000. Closing stock, opening stock. Closing inventory 900. Opening inventory 1200. So purchase has to be 9,700 liters. Purchase has to be 9,700 liters. Last one. It's about budget to be received in September. June, July, August, September. $65, $70, $60, $85. $65, $70, $60, $85. Paid in the month after sales 50%. Second month after sale 25%. 50% from here. Plus previous month 25%. Plus third month after sale 20%. Correct? That is 5%. There are no discounts mentioned here. 60,500 would be the right answer for that. 60,500. Here, good. Please check all these questions and answers. If there are anything that not very clear, feel free to drop a message in the group. I'll reply within the day tomorrow. That's 21st. I'll try to reply. Yeah. Thank you.